Now that 2019 is receding into our rear vision mirror, it's time for our annual coulda, woulda, shoulda review of what markets actually did do during the year. Now, take note, I won't be making any pronouncements as to what I think markets will do for the coming year. I won't be making those pronouncements because I have no frigging idea. Nor do you, nor does anyone else. And if you listen to people who say that they do, well, that's up to you. That's a decision everybody makes. But I will state without fear of contradiction, markets are unpredictable. If you wish for some reason or another to believe in predictions because of the psychological comfort they bring you, good luck with that. In terms of looking at how markets perform during the year, we can have a look at how each of the world markets fared. And what I've done here is I've taken the major world markets and I've looked at their one-year performance. And as you can see, it's the usual array of the usual suspects. As a generic statement, as a general observation, the majority of world markets last year did very well. At the left-hand side, in terms of our top performers, you can see the usual suspects that we've had over the past few years, NASDAQ 100, NASDAQ Composite. But intermingled with those are a collection of Chinese sub-indices. Intriguingly, bookmarking this collection down at the other end is another Chinese sub-indice. This simply highlights to me something I'll come back to in a few moments, the notion that market selection is immensely important. And in actual fact, as a general statement, as a general rule, market selection is far more important than stock selection. Pick the right market and you've given yourself an edge. As you can see here, we had a fairly good year, just over 20.92%, lagging slightly behind the Dow Jones, but ahead of Canada and the Nikkei. That for us is a very, very good year. And the implications of that will become apparent when I begin to look at the performance of individual stocks within the ASX 300. But when I went searching for the world's best markets, I got a little bit of a surprise. And I have to admit, this is something I had to check several times because I wasn't quite certain as to the veracity of the data I had. The two best performing markets in the world, in terms of those that we are familiar with, are Greece and Russia. Intriguingly, New Zealand is also in there. So not only are we well behind the Kiwis in things such as allowing women to vote, gay marriage, a whole host of other social initiatives, their market beats the crap out of us again. And we can see in here, we've got some usual suspects. So we've got the NASDAQ and the Russell 3000 growth. But the very, very good standout performers are very idiosyncratic markets. The implication here is that these are not markets you would ordinarily come across, nor are they markets that you would ordinarily trade. They have a whole host of issues when it does come to trading them. Things like liquidity issues, regulatory requirements and the like. And the mere fact that many of them, such as Russia, are simply dodgy. There used to be an old saying that if ever you wanted to see how a hedge fund was going to go broke, look for the hedge fund that was investing in the most obscure of markets, and they would be the one that went broke. So whilst market selection is our most important criteria, it also has to be tempered with a degree of common sense. Because when I look at this, there is simply no way known I would be investing in either the Greek or the Russian market because of the reasons I've just mentioned. They are problematic. It's not the same as investing in, say, the NASDAQ or stocks within any of the Russell sub-indices or our market or the New Zealand market. It's not the same as investing in Singapore or Hong Kong because these have a firm rule of law that we're familiar with. So all your judgments need to be tempered, and tempered with common sense as to how the world actually works, not how you would actually like it to work. When I looked at the S&P 300 and I began to break down the performance of individual stocks in there, I noticed something really interesting, and this is a function of the fact that our market has had a very good year. When the overall market has a very good year and is trending strongly, within that market, within that ecosystem, you'll find shares that do extraordinarily well. And you can see here, what I've done is I've mapped the number of stocks that have a performance greater than 100% for the year. And there's not just one or two, there is quite a collection. AVH tops our scale with a return of just under 700%, ISX at just under 600%. So we have a collection of stocks that do exceptionally well. And they do exceptionally well because an index that is moving is providing the interest and impetus for them to do well. Now we run into a problem. And the problem is it one of chicken or egg? Is it that the stocks do well that make the index do well, or the index do well makes the stocks do well? I actually think I have an answer to that. When you look at the construction of an index in Australia, there are probably 10 stocks that do all the driving because of the weighted nature of the index. None of these stocks here as an aggregation can move the index. The index movers for us are the household names. They're the BHPs, the CBAs, the Westpacs, the Rios and the like. They move the index. These little stocks just seem to follow along in the wake of the index doing well. Once you begin to get investor interest because an index is doing well, these little stocks begin to take off. I then actually pulled apart the performance for the entire 300. Don't worry about the names down the bottom. I just want you to concentrate on the shape of the curve. As I said, when you get a market that is doing very, very well, you will get these outliers. What I've done here is I've noted the average performance of the stocks within this group. The average performance is 32.17%. Yes, averages are a little bit dodgy as a measure, but they do give us a nice broad yardstick. And what you'll find is that 99 stocks were above the average. So this is a series of performance returns that is very, very skewed. It means, in very simplistic terms, that 1 in 3 of the stocks within the index had above average performance for the year. This is already giving you an indication as to where your interest should have been for the year. And that will become even more apparent when I look at other markets. But the thing to note here is that when you get a market that's performing poorly, you get a very flat distribution. You won't get these outlier tails of stocks doing exceptionally well. Interestingly, those stocks that did poorly did not do as poorly as one might expect. Again, this is a little bit of an artifact, and we have to be careful here when I'm talking about stocks that do poorly within an index like this, within a fixed system. When a stock in an index does very, very poorly, it's bumped from the index, it's dropped out. So if we were to map the performance of the entire market, this would probably look different. This tail would look more symmetrical. There would be stocks that had lost 70, 80, 90% of their value, and there would be lots of them. But we can't have a truly symmetrical distribution because a stock can't lose more than 100% of its value. So we're always going to get this somewhat tilted look to these sorts of distributions. In terms of other markets, there's one or two things that are important to note here. These are how sort of the major commodities performed for last year. And you can see some did well, some did poorly. Palladium has been on a tear for a while and is probably one of the best commodity trends I've seen for ages. It is effectively a chart that starts bottom left and ends top right, which is a perfect uptrend. And you see down here with live cattle, and this is the one I want to use to start as an example. You can see that it says it only had a performance of 1.7% for the year. But that's misleading. because it doesn't tell me anything about the trajectory of how that figure was derived. And if we actually have a look at live cattle for the year, you see the year started off very ordinary. Commodity was flat, lifted a little bit, and then collapsed. It then reversed and took off. So in the chart you have this lovely V. You have two tradable trends. But if I simply went on what the performance of this commodity was over the space of a year, now remember, all that performance does is say, well, the price on the 1st of January was this, and the price at the end of December was this, and the difference is X. Tells me nothing about what happens in between. But we need to avoid the assumption that because something has done very, very well, that it did so in a tradable manner. The example here is natural gas. Natural gas was down about 25% year on year. But if we look at the trajectory of how it did that, price fell away early in the year, and this initial move down is very bumpy. This is not a clean, clear move, because you can see price collapsed, then gap back up and filled that gap again. Granted, the overall trend was down, but it would still be a very nerve-wracking experience. And price effectively bottomed out in August and then went into a band and traded sideways. It would be a very astute trader who managed to get most of the slippage in the beginning of the year, who then did not get chewed up by this wide banding move in the last quarter of the year. The same can be said to be true of foreign exchange. But here I'm going to add in a rider. And I'm going to make a few statements that are going to make people who are addicted to FX unhappy. The first is a simple blanket statement. FX in no way delivers the returns people say it does, not unless you are geared to a staggering extent. Yes, I know there are people out there going around saying we're getting 800% per annum. Bullshit you are. It's very, very easy to make mistakes in systems testing. And in the FX systems I've seen and which have been flogged to our people, there are lots of mistakes in their testing. The reason I say that is simple. We have here the performance, the year-to-date performance of a series of major pairs. And again, granted, we can't make any judgment about what their trajectory was or what their trend was during the year simply by looking at the year-end performance for these. These, like commodities, are different from stocks. So our basis for measurement is slightly different. But what we can do is look at the performance of each one throughout the year and look at the range over which it actually moved. And the ranges over which it moved are very, very small. And this is often a function of FX. They tend to move often over very small ranges. And they often do so in a very, very noisy fashion. And I'm going to offer another blunt statement that I tend to make. And this is based upon the evidence of us going through hundreds and hundreds of trading plans and their associated returns. When we drop FX out of the system, the overall system performs better. It's a little bit akin to with stock trading. In stock trading, you have the option of going long and short. When we get people to drop or remove their short trades from their performance figures, the performance of the entire system lifts. Some approaches simply act as a drag. I understand why people trade FX. They think they have to. Or they're simply addicted to the noise that FX generates because FX trades almost continuously. And so for people who think that activity equals profitability, then it is the ideal market. And if I were to construct one of those enormously clever polls that psychologists generate where they ask a question without actually asking the question, I can probably guarantee you that the majority of people were trading FX for entertainment and nothing more. And it has to be entertainment because it cannot generate the unbounded returns, for example, that equities can. It is impossible for you to go to bed tonight with the Australian dollar, let's pick a round number, say at 70 cents, and wake up at the end of the year and it's $7. That won't happen. Yes, I understand that FX is leveraged and that does enhance the gains, but so too are commodities. So too can be equities. The level of gearing can be analogous to one another. So the question I would get you to ask yourself is, do you want to trade 50 times and make 20% or trade 20 times and make 50%? I can almost guarantee you to an individual that if you're an FX trader, you will opt for trading more and making less because it attracts that sort of personality more than anything else. Yes, I understand the value of diversification and the like, but it is here that I will defer to Warren Buffett, who I believe said that diversification is simply for people who do not know what they are doing. As an example, let's compare the range of those FX pairs to the range we saw in gasoline and live cattle. Gasoline traded in terms of percentage returns on offer over a very large range, from flat to up 60% to up 20%. So you have a tradable range in there. And it's here we see how live cattle performed, where it swung from almost being at unity down to being down around 25% and then back up. So you had that V formation we saw before. And I know what FX traders will say. Well, they'll say, yes, you're looking at a daily chart. What I'll do is simply convert it to 5 minutes and I will get 50 pips a day. No, you won't. What you'll do is entertain yourself and make the person on the other end of the trade, the market maker, quite wealthy. This is why market makers like IG Markets have a market capitalization of around 2.5 billion, and you don't. The question is, how hard do you want to work for your money? And we come back to this notion of the importance of the selection of the market. And this applies not only when you're comparing equity markets, but it also applies when you're comparing distinct markets, such as equities, commodities, and FX. How do you want to make your money? This is our best performing pair. And you can see there's a fairly wide, broad V in there, where price falls away in first half, regains second half. And again, FX traders will get, I just get all of that, which is somewhat, it's somewhat akin to what I hear from equities traders when they see a stock trading between 20 cents and 25 cents. They just go, well, I'll just buy it at buy it at 20 and sell it at 25, and I'll just do that continually. No, you won't. What'll happen is you'll buy it at 24 and sell it at 22, and you'll do that continually. And that'll keep you occupied and entertained, but it certainly won't make you wealthy. As a point of comparison as to how hard you actually want to work, this is AVH, our best performing share of the year. And you can see that it takes off in February, March. Breaks out of that congestion, makes a new high, takes off. With a simple, fairly wide stop, you'd still be in. And you would have had opportunities to add to the position. Granted, this takes a different sort of skill, but the skill it takes is psychological, it's emotional in nature. It requires you to be patient and simply to leave things alone. There is no problem that a trader can't make worse by imposing themselves on the trading system or having a view. A similar pattern appears when we have a look at I sign this. Our breakout occurs in February, and with our long stop we are kicked out around the 105 mark. But we're in at the 15 to 20 mark. So the return is still exceptional. And with Poly, the actual breakout occurs in 2018, but you get another chance at the beginning of the year to go again, and you would still be in. So you would have made one, maybe two decisions, as opposed to making continual decisions every day. This is how trades that generate 250, 300R returns are created. They're not created by trying desperately to get 0.1 of an R every day or multiple times a day. And just for shits and giggles and to be quite cruel, I looked at the value of $1 invested in AVH versus the value of $1 invested in the pound. And this is unfair, I admit that, because we're not looking at similar things. You're not looking at buying a currency at the beginning of the year and holding it. But what it is reflective of is opportunity. The thing you seek, the thing your trading system seeks, or that is at the heart of your system, is it looks for opportunities. And those opportunities must provide you with an edge. Equities provide an unbounded distribution. That is, they're not capped. It is quite possible for a stock to go from 10 cents to $10. You will never get the equivalent move either in a commodity, despite what the gold bugs say, and you will never get the same move in FX. So, granted, it is unfair, but it goes to the nature of opportunity. And how hard do you want to work? A single decision at the beginning of the year could have yielded you this return for AVH. God knows how hard or how many decisions you would have to make or how much risk you would have to generate a similar return on an FX pair. So we have this notion of market selection. So what have we learned about 2019? Well, 2019 was the same as 2018, which was the same as 2017. It's just that the actors have slightly different parts. They have slightly different lines. And that's the issue about markets. The markets this year in 2020 will be exactly the same as 2019. It is just that the actors will be rearranged. They will have different parts. Your job as a trader is to actually spot that change in script and to actually be aware of it and be able to take advantage of it and follow it. And so if I'm going to make a prediction, my prediction will be twofold. The first is the market this year will be the same as the market last year. There will be things that go up a lot, things that go down a lot. There will be a whole host of things in the middle that don't do much, and there will be some that go nowhere. But there is another prediction I'd like to make, and that is really quite a simple one. And that is that for some of you out there, we will be having the same conversation again next year. Because as Karl Marx said, history repeats itself, first as tragedy, second as farce. He could have written this about traders, because one of the things I've noticed about traders who don't do very well is that they simply repeat the same mistake over and over again. It is almost as if they are incapable of learning from their mistakes. So you have this situation, for example, where people by dint of personality, technology, time, whatever, cannot trade intraday, but attempt to. And they will continue to do that because that's what their psychology wants. That's what they believe trading is. You can make 10 trading decisions a year and still call yourself a trader. You don't have to make 10 an hour. In fact, I would posit that the person who makes 10 an hour is little more than a gambler, irrespective about what they say about their risk control and all the rest. because they're trading for entertainment, which unfortunately seems to be the default setting for most people. And what is intriguing is that people seem to elect to trade the market that they are least capable of trading.